really, it's everything that you need to know to be able to set the company up so that you can raise money. And then how do you raise money? So I'm Joe Daniels. Again, I'm a partner and the co-chair of our venture capital emerging companies practice at McCarter in English. I'm actually in the Boston office of McCarter. I'm usually in New York. It's a 175-year-old full service law firm with startup to Fortune 50 clients. And we basically have a department for everything a business needs. That's real estate, IP, tax, litigation, and corporate, which is the department I'm in. We do corporate finance and M&A. We have about 400 lawyers in 9 offices, going on 10 in North America. But we have a global practice because we've been around so long, and we've been representing companies in cross-border transactions all over the world during that time. We've represented startup founders and investors forever, including Thomas Edison and his family's Edison Venture Fund. Back to the VC emerging company practice, we basically focus on formation, financing, growth, and exit, right? So that's helping a company form up, whether that's one person with a business plan or a serial entrepreneur team. It's done it many times before. Dividing up the equity and making it subject to vesting to protect that equity, protecting the IP with agreements and filings, and then raising money in successive rounds of angel and venture capital financing, from pre-seed to seed, safes and convertible notes, Series A, B, C, D, all the way up to Series N for SpaceX, for example. And then helping the companies grow through acquisitions and partnerships and commercial agreements of every type, international joint ventures, that sort of thing. And then exiting through an M&A deal or an IPO. So our league tables for this kind of activity is the pitch book. This is the most prominent source. And, we're pretty nicely ranked as high as, top 3 in our region and 6 to 9 nationally and globally in terms of the number of angel and VC deals that we close every quarter and every year. I believe they're only counting preferred stock deals, not the smaller note and safe deals. And we represent thousands of startups and VC funds all over the world. Here's some examples here's some newer ones, here's some bigger, older ones. And, the sort of the volume of deals that we do. And actually in 21, I think we're up to like 182 deals for more than 8 billion this year, or definitely on track to beat 21. Not a surprise because the venture markets are hot. We also have 120 IP lawyers that are specialists in most technical areas, from AI to telecommunications, but mostly in technology and life sciences. And they handle our patent, trademark, and copyright, prosecution, litigation, and licensing. And we have over 100 litigators ready to sue and defend all over the US. Unfortunately, that comes up. And everything else we think a business needs. I personally have been doing this for about 25 years. And I basically joined the group in Palo Alto that took Netscape public and sold it to AOL. So I was there during the dot-com days all the way through 03. And I've represented a bunch of big public companies like these listed here: Autodesk, Invitrogen, Monster, Polycom, now Plantronics, thousands of startups, bunch of private equity and venture funds like these listed here, Credit Suisse and Morgan Stanley and Oppenheimer on the underwriter side of IPOs and private placements. And so I've done about 25 IPOs and follow-ons and scores of M&A deals up to $1 billion and thousands of financing. So I focus on tech and life sciences like my group. So that's our experience. And now let's get into the subject matter. So on the agenda, there's a lot of bullets here, but this is really just like, how do you form the company and get it set up for funding? Then we're going to talk about IP. What is IP? How do you protect it from the beginning? And then how do you raise money? What are the basic criteria? What are the typical terms of those financings? That kind of thing. So starting with, what is a startup? This is a simple diagram to describe that. So you're probably the founder. If you're an entrepreneur on the line and you're contributing intangible assets to this startup company, then additional people are added as the team members, technical personnel like the CTO, developers, marketing person. They provide services to the company, usually initially exclusively or mostly in exchange for equity. And then the investors provide the cash. And the key point is that all 3 elements are combined into this one legal person, so that everybody involved, investors, founder, people who join the founder, know that everybody's all in terms of this business in that one legal person. With that added level of certainty, then everybody can commit to it more and things like that. So when do you form the startup? Basic question. In my mind, when you have more than one co-founder or more than one person involved. Of course, if you have limited cash, you want to save money on that, understood. But, formation packages for startup companies are like $1,500, including all the filing fees now. Or when you have a material contract or obligation to limit your personal liability. You don't want to be personally liable for the business that you're starting. That's the way our system works. You don't have to be personally liable for that. Why should you? And the reason for obviously forming a company when you have more than one person involved is so that if there's a dispute, then there's an easy way, hopefully a foreseen way of resolving that dispute without litigation or the threat of litigation. So what is the type of company that you should form? You people could be from all over the world. And the answer generally, if you're going to try to raise, if you have a venture model company, which is a company that is going to require investors' cash to scale, then the answer is a Delaware C corporation. I haven't gotten to Delaware yet, so let's stick with C corporation. So why? From a tax perspective, it's very important in the U.S. for all the U.S. stockholders of this company. The greater of 10 million or 10 times the purchase price of investments that they make in the company are exempt from capital gains taxes. So that means the founder gets a $10 million exemption. An investor who invests $2 million gets a $20 million exemption from capital gains taxes. And if you simply buy the stock and then later sell it, which is the way it's set up for founders and for investors, then and your exit proceeds are less than that amount, then that means it's tax-free, except at the state level. But it's like a $2.5 million benefit on the 10 million level. And then the C Corp is not only preferred, but almost insisted upon by venture capital firms and angels. They don't want pass-through gain and loss. I mean, imagine you invest $100,000 in a hot startup and great news, it becomes profitable, but then you start getting a tax bill every year. And you're not getting any money back from that $100,000 to pay that tax bill, because usually that's not baked in to an investment. So nobody wants that. And then the VCs have not-for-profit investors that would have a penalty tax if they receive that pass-through. So most VCs, they'll require you to convert to a C Corp anyway. So if you start out as an LLC, worst case an S Corp, which is a pain in the ass to convert to a C Corp, you're going to have to take on that expense anyway. And then, of course, right now under the 2017 Tax Reform and Jobs Act is a 21% corporate tax rate. I think the proposed is 24, 25, still potentially or likely lower than your ordinary income rate. Just a quick note on LLCs. Basically, everything about an LLC is the opposite of the C Corp. You can't get the QSBS. And by the way, with the QSBS up here, you have to hold the stock for 5 years. If you have an LLC for 1 year, you convert it into a C Corp, and then you sell it after 4 years, you do not qualify for QSBS. That's why you want to start with a C Corp. Can't get the QSBS with an LLC. It's got pass-through tax. Generally good for a lifestyle business that's going to make periodic distributions of profits. But a startup like tech and life sciences, the kind of people that are probably on this call, you don't ever distribute the profits. You reinvest them in the business to try to scale, because the growth benefits of that scaling exceed the value of the distribution, unless you're an incredible investor somehow. Most people are not. So then in what state should you incorporate? Delaware is the answer. Why? It seems like such an absolute, the way I say it. Short answer is 90% of new IPO companies come out of Delaware, 50% of US public, about 2/3 of the Fortune 500. Some people are holding on because of an institutional inertia, but Delaware has definitely come out in the lead. And the reason why is because all the investors and bankers and lawyers and accountants and everybody that works on building companies and investing in them and selling them and taking them public have memorized Delaware law, where they understand it very well. They feel very comfortable with it, whereas they're just not as comfortable with all the others. And so we recommend generally that you form your company in Delaware. Just some basic governance concepts, because people get all this stuff confused. Note that the stockholders are supposed to be in charge. They elect the board of directors, but majority ownership accompanied by founders is not essential for control. Why? Because in most financing transactions over a certain level, the parties enter into voting agreements that determine who's going to be on the board, and the board generally has to approve all major corporate action. The board generally controls the company from a day-to-day basis. So if you simply have that kind of negotiated voting deal in place, then you don't have to have majority ownership for control. But obviously, you want to have the largest percentage ownership as possible as a founder or as an investor in order to maximize your economics. And we usually usually suggest that founders try to retain at least 20 to 30% before their first price round, if not a lot more. The board of directors, like I said, it controls all major corporate action, but also controls the hiring and firing of C-level officers. So that's you. So what that means is because there's very often a vesting component to the stock that you receive, especially after an equity round, is that whoever controls the board can terminate you, and that can cut off your vesting, and then you lose some of your stock, right? So it's important for the founder to try to control the board as long as they can, as long as, assuming the founder thinks that they're in a good position to make the right decisions for the company. Officers, CEO, CTO, CFO, CMO, and all the people beneath, vice presidents, whatever, they're in control of the company with delegated discretion from the board. So the board can fire all those people is the bottom line. So again, showing the importance of controlling the board, and then rather than putting important and well-connected people who say that they can raise you money and introduce you to potential customers, et cetera, on the board, which means you have to share control with them, we usually recommend in the startup context that you make them an advisor. That is to say, you give them a small equity grant between 1 and 1.5%, and you have a vest over 24 months. Okay, next, one of the two main types of documentation that you want to put in place with a startup before you raise money is equity documentation. So what is that? Basically, it's an agreement that says that you own this kind of stock or option, and this is the vesting. And what's the benefit? Or why do you want to put it in place ASAP instead of just waiting and agreeing with people orally and then putting it in an email and then changing it up over time as things develop? The main reason why is because you always have the shares vest, so you don't need to worry about having to change those vesting schedules or how many shares a person has, because you can always terminate the person and buy back their stock, right? All of it usually within the first year. And it avoids disputes between you and other people on the founding team about who owns what, because those things can be extremely disruptive and can kill the company at an early stage. It's also a tax issue. If you don't grant your stock far enough away from your first equity round when your equity is priced, then it could create ordinary income taxes for you and your team. And investors are going to want it. The first thing that they ask for is the cap table and all the equity documents to show who owns what, because they want to make sure they're buying the right percentage of the company. So all this needs is a document signed by the founder, says I'm granting all this stock to these people, and little standard form stock purchase agreements. That's why it's part of typical formation package. What are some concepts about granting the restricted stock versus options? So generally, you grant the restricted stock before the first price round and what is that? It's basically common stock of the company, the same stock that the founders are going to have, because you can grant it to people for virtually zero. We set it at usually par value, 000 or 1.0001 or 0.0001 a share, which is a very small amount for whatever number of shares, right? And it's on a vesting schedule, and so you get the stock for virtually zero. So then if you sell it more than 5 years later, you have the $10 million exemption under QSBS, and the first 10 million is tax-free from a federal perspective. That's the best possible kind of deal that you can get in the US. And if you're vesting over time, you do have to file something called an 83B election within 30 days of issuing the stock. Otherwise, you could have a lot of negative tax consequences if you don't. So some basics about restricted stock there. And then you usually grant your stock options after the first priced equity round because you priced the equity. So then if you were to give common stock for par value to your team members or new team members you hire after that first priced equity round, you're giving them ordinary income equal to the fair market value of that stock. and they probably don't want to have to recognize that or pay for that. So instead, you go out and get a 409A appraisal. You determine what the fair market value is, and you grant a bunch of stock options on the common stock at the fair market value in the 409A. And so it's the next best deal from a tax perspective. There's no tax on receipt of that option grant, and there may be, of course, on exercise and sale, but that's it's generally the next best potential. You might end up having to pay only capital gains tax if you hold if it's incentive stock option for an employee, and they hold it for a year after they exercise. Key point, I guess, about all that is that you don't need to grant options before the priced equity round. People often get this confused. I don't know why they do it. I can't see any rationale, except maybe when people leave, they only have 90 days to exercise, but that's probably not what anybody expects. So anyway, everyone in the company should vest over time. It's hard to understand, but if you're the sole founder, and as I mentioned, you're in control of the company like you should be, then you're not going to fire yourself and you're not going to resign. And you're going to have control over or whether or not that structure ever changes. So there's no real risk to that founder of the vesting, right? But you want to show all the other personnel that you're vesting, because think about it: if you split up among three founders, a third of the company, and then one of them leaves 2 days after you issue the stock, you don't want that one person to walk away with a third. It's not fair. You want to be able to buy back their stock. That's why everybody has vesting in these companies generally. Why we recommend it. Investors want everybody to vest because these grant sizes are intended to be for a 3-year or 4-year commitment, because it's really hard to get people to work on a startup when they're not getting paid anything as a salary. So it's an incentive for them to stick around and build it. So the typical vesting schedules on shares are a 3-year, 1-year cliff from the time that you start for a founder. That's from the time you start, not from the time of incorporation. What that means is 1/3 after 1 year, 1/36 each month after that. So if you quit within the first year, then you don't get anything. That's the typical vesting schedule coming out of the Silicon Valley, starting in the 1970s or so, and it's remained the same. Somebody joins later, an employee or a consultant, it's a 4-year, 1-year cliff. That's 1/48 after 1 year. Sorry, 1/4 after 1 year, 1/48 each month after that. And then directors and advisors, 2 years monthly or 1/24 a month. And also consider the non-typical structures, milestone-based structures for people who are salespeople and other people you can tie down and vest their stock based on the achievement of specific operational milestones. The next major type of agreement that you want to put in place before you raise money is a service agreement for every single person who's providing services to the company. Why? Because the people who provide those services are contributing in intellectual property with those services. And there's other reasons. So we usually classify in the United States personnel into 4 categories: advisors, consultants, interns, and employees. That's alphabetical, right? Advisors are really consultants, and interns are a special classification that have to be treated carefully to avoid disappointing the governmental labor authorities. So that there are different forms for each of these different types of personnel, because different laws apply, right? Or different business circumstances apply. They all achieve 5 important things. 1, requiring the personnel to not disclose or use the company's proprietary, confidential information. Requiring the personnel to assign over all IP, intellectual property they created on the job. And then prohibiting solicitation of customers and suppliers and disparaging the company when they leave the company. And the reason for all these things is because employees will do will take a negative position about all these things. They'll disclose to their new employer all your secrets. They will say that they own the IP and then go use it at their next job, and they'll steal your customers and suppliers when they leave. It's just unless there's something where they promise not to do that, and sometimes even if they have. But I guess the point is that if you have that agreement in place, investors are going to be happy, and it gives you some leverage against the new team, the new company that person's working with, to stop them from using any of that information and IP. And you want to tie the equity vesting to the duties in the service agreement, so you can leverage the person to actually perform the duties that they said they set out to perform. Other big important things to put in place before you raise money: have NDAs with everyone that you're sharing any significant company IP with. Consider filing for patent, trademark, and copyright protection because it looks like you have an IP moat, protecting the IP. Confirm the clear chain of IP title with people that join. If they're working at a university or with another, let's say a company with a lot of resources in the same sector as you, then if they've signed anything that would protect their IP, then you have to make sure that you're not incorporating that into your business. Also have some lawyers, if you just for at least a small amount of time, look at major agreements. For software companies, really for almost every kind of company these days, the terms of use and privacy policy are huge because it's usually the principal agreement between the company and customers or one of them. Also the basic forms of customer, supplier, distributor, affiliate agreements, because your IP is in play there, your trademark, your trade secrets, and maybe even patented technology. You just want to make sure that you continue to own that despite all the collaborations going on or transactions going on with those third parties. And any important deals like licenses in and out of technology. Also resolve the major regulatory issues before you go talk to investors. You got just consult with, if you're a healthcare company or biotech, medical device, the pathway, so that you know exactly how to get there, what steps are required, what filings need to be made, what meetings with the FDA do you have to have, how much is it going to cost, all these things so you can explain it. You don't have to have it all done at every stage when raising money, but investors will want to see you achieving important milestones and knowing how to get there. And a note on equity plans: you don't need an equity plan until you need stock options, and you don't need stock options until you've done a priced equity round. If you have them in place, then all the accelerator securities and early stage investment forms usually include those equity plans and end up diluting the founders and not the investors, right? So why have it in place if you don't need it? I'm going to briefly talk about the four major areas of IP law before we get into the discussion of fundraising. We have about a half an hour left, so try to get through this in 10 minutes. I'll leave plenty of time for Q&A. So what are the four different types of IP? Patents, copyrights, trademarks, and trade secrets. We're going to roll through that in that order. So what are patents? Just like it says, 20-year exclusive right to prevent others from making, using, selling, offering, or selling, offering to sell, or importing your patented invention. That sounds valuable, right? I mean, everybody knows sort of what that is. But note that there is a balancing act, and VCs for decades thought it didn't make sense to file patent applications on software business processes, especially in light of more recent Supreme Court cases on the issue. But there's a little bit of a balancing act with the U.S. switching to the first to file system, which is to say that if you've created a trade secret, which is a great business process within code, or it's a genomic sequence or whatever it is, and you don't file the patent, and if someone else invents the same thing and has clear title to that IP, they can file a patent and then get protection and then stop you from using the IP that you created first. And so there's what I see a lot of startups doing is filing a provisional patent application until they have the ability to better analyze whether it makes sense to continue with the patent process. It's not anywhere near as expensive as like $2 to $3 grand to get that on file. It's just a consideration. And the different types of patents are utility patents, which protects the way an invention works; design patents, which protects the ornamental appearance of an object; or foreign patent applications, which you file under the Patent Cooperation Treaty in something like 180 countries now. Basically it just streamlines it so you can get on file in a bunch of countries, but you have to pay all the filing fees in all those countries. So the good news is you have a year from the time of the filing of the provisional to even think about that. Here's an example of utility patent: a system and method for detecting and tracking features and images. You see that there's this decision tree here, an abstract, and this thing is going to go on for pages, but that gives you an idea of what conceptually that looks like. Here's a design patent example. It's just the USB flash drive housing depicted here. So how do you determine if you should file a patent? Don't ask me, I'm a corporate lawyer, but I would recommend you have an initial consultation with one of our patent prosecutors that knows your scientific area of your business, of your industry, and they're usually happy to talk to you for about a half an hour and help you develop a strategy, whether or not you should patent, if you should file a provisional or non-provisional, et cetera. And next, copyrights. What is a copyright? You've seen this before. In fact, there should be a copyright notice right down here saying copyright Joe Daniels, 2021 for this slide deck. But I just said that. That's what it is. Copyright Joe Daniels 2021. So to protect works of authorship, stuff in your head, like books, music, slides on startup law, that are made and reduced into a fixed form like these slides from unauthorized copy, distribution, and display. So you have all these stock photo companies that are constantly sending out cease and desist letters when people copy those photos and put them on the website. And all they did was, put this circle C, usually on their website where it was copied, or on the website that someone else was displaying it. But you can also file for federal copyright registration. We usually recommend that clients at the early stage do that on their own. They just go to the USPTO website, complete the appropriate form, visual, literary, deposit a copy of the work online, pay the filing fee, and you have that federal protection in all 50 states, and you can sue people and send cease and desist letters that have a little bit more leverage, probably a lot more leverage. What is infringement of a copyright? The concept is where there's a substantial similarity between the infringing and copyrighted work. Obviously, it's a very complicated question. You can consult with an IP lawyer about those issues if it comes up. Next, trademarks. What is that? That's the name, logo, design, or sound that identifies the source of your goods and services. And the standard for infringement is a substantial likelihood of confusion with another mark. So if you have, obviously there's Apple computers. So if you had, Apple, hardware store, that's probably not. I'm not a trademark lawyer, but it's probably not a problem. But the thing is that Apple has tremendous resources, and as soon as you begin to use that in commerce, they're going to get reports, and they might send you a cease and desist, and then you have to change your name. So you have to be concerned about what the name of your company is, what brand you're marketing your goods and service under. We usually recommend at least a Google search when you're deciding what that's going to be for your startup. Go down numerous pages, look at every company that has slightly similar business, and then look into them and see if they're using it, if they have a registered trademark, and then if you really want to be covered, you talk to, or you send someone like me an email. I send my trademark lawyers a question to go look at it, and you get some input from lawyers as to whether or not you have any risk in using the name, whether that's in the US or anywhere else in the world. And then finally, trade secrets. What are trade secrets? These are technology that derive independent economic value, subject to reasonable efforts to protect it from disclosure. That's the reason why you have to have all these agreements with the service providers with confidentiality provisions and NDAs with counterparties that you share, potential trade secrets of your company with, because you have to make those reasonable efforts. If you fail to do that, then it becomes public information, and it's no longer a trade secret. You can't protect it. Anybody can talk about it. And of course, if it's software, or the classic example is the formula for Coke, which is kept in a bank vault across the street from the Coke headquarters, supposedly. Obviously, only a few people have access. Okay, so that was pretty quick through IP. So I got plenty of time to talk about raising money. So how do founders raise money at early stages these days? We usually split that up into pre-seed and seed, where there's a pre-seed round of, let's say, $150,000 to $1 million, selling 1 to 10% of the company. And in those cases, we usually see what you're dealing with is a strong founding team. What does that mean? Ideally, someone who's already formed and successfully sold a bunch of companies or taken them public. Of course, that's not everybody, but any sort of experience with the business that you're going to be operating in, I think, is helpful. Any other business experience too. Resilience, coachability, all these things that you can see in the media that investors are looking for. And then also some demonstrated product market fit. So, hopefully demo, MVP, some description of the product or exemplification of the product, and then analysis on the total addressable market size, and connecting the dots so that it's clear there's a fit. And what do people do? They go out and they get like letters of intent from potential customers, big customers, small customers, show traction in the however they can, right? But usually at this stage, you might have 10,000 a month in revenue, but I think most of the companies don't. Then there's the seed round, where you're raising usually a higher amount of money, 2 million to 10 million for 15 to 45% of the company. And of course, when I talk about these percentages, it could also mean safes or convertible notes that eventually will convert into that size. And what is required for that situation? Not only the strong founders and apparent product market fit, but also meaningful traction. So looking at 2020 and 2021, 80% of these companies have revenue. The investors are often targeting over $1 million in ARR, and I think at least 10,000 a month. So almost 100,000 a year. The investors are usually accredited individuals, or what we call angels, and early stage VCs. And the deal is often a company-led round, especially for the pre-seed, sometimes for the seed, meaning that you talk to investors about your deal and they actually expect an ask in the deck. We're raising $2 million on a safe with an 8 million cap would be the ask, or an example ask. And then if investors are interested, they say, well, what's the next step? Can you send me a form of the safe? And this is very often what happens with my clients. They've put together a deck, they started talking to investors, they come to me and say, can you give me a safe to send to these investors? They might be interested. And you may not know what terms you should use, right? So it's very commonplace for clients to come to me and say, what should I offer? Or they've checked with 5 advisors and they want to confirm it with me. And what I usually find is that people who understand this space and work on deals all over the country, like I do, and those advisors that hopefully you have as well, everybody's going to have a consensus about a number for a cap on a convertible note or a safe, a valuation for an equity round, just based on where the market's at that time, based on, again, team, product market fit, and the level of traction. So to finalize that point, clients often come and ask me, what should I do? What should the cap be? Should it be a discount or a cap or both, or et cetera, et cetera? And I'll just tell them what I think it should be. And then very often those terms sell to the investors successfully. Other times we have to adjust it, of course. So what are the popular seed financing structures? I alluded to that before when I was talking about. It's basically convertible notes, safes, which is simple agreement for future equity, or Series Seed preferred stock. So why would people sell seemingly complicated things like convertible notes and safes? A lot of people have no idea what that is. I understand stock. If I have 10 million, let's make it simple, 100,000 out of a million shares, then I own 10% of the company, right? Very sort of simple to understand. But what does a note convert into, or a safe? The reason why is so that you don't have to decide what the company valuation is, which would actually determine the exact percentage that the person who invests is going to get. Why is that a good thing? Because they often think it's going to be really low, like 3 million, and you think it's going to be high, like 10 million, or maybe the difference between 5 and 10. Right? It's hard for people to come together. You can't, if you say split the baby, how about 7.5? They say no, I think it should be 5. So then what do you do? It's also cheaper even if you use us to perform to create or to break out the standard company favorable safe or convertible note. It's going to be a few $100 as opposed to potentially 5 to 35K to produce the Series Seed preferred stock forms. It's just the nature of the market terms and where that's at. So it's cheaper. And then after you sell the convertible notes and safes, you can still issue that restricted stock, which is better from a tax perspective than those options I talked about before. So perfect for a pre-seed round, still pretty good for a seed round. At least if you're doing like staging out your seed rounds, you're doing a quick 2 million and then want to raise the valuation and then raise another 5 and seed 2 or seed pre-A seed round, whatever, then notes and safes are great for that smaller piece. But why Series Seed preferred stock then? Because a lot of investors, for example, notably the New York Angels, I think one of the most prolific angel groups in the country, certainly in the Mid-Atlantic, generally will not invest in convertible notes and safes, or at least that's their sort of group position. Of course, the individuals, they often do. They want to set a specific valuation on your company so that they know exactly which is low, and so that they know exactly what percentage they're going to get, because with all the dilution that comes after that first round of angels, that they'll know where they end up and then what their projected return is going to be, because they've seen so many angel investments get really diluted over time, and they've because they've lost so much money, right? So they just won't invest in notes and safes. So you have to give them preferred stock, or you want to raise enough money in that seed preferred round, because both notes and safes convert when you do that first priced equity round, which is usually that Series Seed preferred round, to convert a bunch of convertible notes that are coming due in 6 months, 12 months, 18 months, whatever it is. So you don't have this hammer of like all these people asking for their money back hanging over your head. It just converts them out, and then they become stockholders, and then they can't ask for their money back. All right, what are the typical terms of convertible notes? So the basic concept of a convertible note is that it automatically converts on a minimum amount of equity financing being raised by the company, which you have control over as the founder, how much equity financing you're going to take. Why? This originates from notes that were created to be used as bridge financing between equity financing rounds, like a 2 million convertible note round in between a 5 million A round and a 10 million B round, because the company needs a little bit more money to get to the B round objectives. And initially it started out as just being priced at the price of the round. Like we're already talking to VCs. It's going to happen in 3 weeks or 3 months, and we're just going to convert this note at the price of the round, including interest. Over time, people got a little bit more aggressive on the terms. So the market is now usually that it's a discount only note, or it's a cap only note, and also common lower of discounted price or cap. That's basically the order of best for founder to least best for founder in most cases. And what does it mean? So discount only means that there's a 10 to 25% discount on that note. So when it converts into, if the price round is at $1, the note converts to 15% discount at 85 cents, and the note holder gets more shares for its dollars than the cash investor that comes in the equity round. It's a cap. And there is a price set, a valuation price, in the hypothetical where I said the investors think your company's worth 3, you think it's worth 10, or let's say 5 and 10. Let's say you cap that note at 7.5, and then so that the conversion price becomes the lower of the round price or the cap. So what that means to the investor is like, oh, I'm not setting the price at 7.5. If you actually raise at 5, like I think you will, or I think you're worth, then I'm going to get the 5 price, which is better for me. So it's a little bit of a compromise as compared to splitting the baby with a valuation in between. And then of course in the lower, the lower of discount or cap, if the round is at 5 and the cap is at, well, let's make it, if the round's at 7.5 and the cap's at 7.5, then they get a lower price than 7.5 based on the discount. So note that from the company perspective, if the conversion formula excludes any other note or safe shares, that makes the note quote unquote pre-money, which can be extremely helpful if you end up raising a lot of money under notes and safes. For example, if the cap on the first set of notes is 7.5 and you raise $1 million, that means that their pre-money is 7.5 under a pre-money note. But if it's a post-money note and at 7.5 and you raise $1 million, then your pre-money price, which gives them a higher number of shares is 6.5, because it's the post money minus $1 million, 6.5. If you then raise 2 million in additional notes or safes, and the formula is post money and includes all those shares, then the conversion formula takes the effective pre-money of the first money in, the million in, to 5.5, right, or to 4.5 actually. So it makes the valuation of the first set of note or safe investors who came in in a post money deal reduced, the effective pre-money reduced by the amount of additional note and safe shares, which can be highly dilutive to the founder. The other major terms are the principal amount invested, which determines the eventual ownership of the company. The interest rate which is usually between 2% and 6%, and the term of the note is usually between 18 to 24 months. That's just where market is at, presumably because it takes 18 to 24 months for the company to build to the equity round. Okay, what in contrast is a safe? Simple agreement for future equity. So the safe is the same as a note, but without a maturity date or interest. So everything I just said about the note, but without a maturity date or interest. And obviously that's better for the company because you don't have that hammer hanging over your head, as I said, about with a maturity date, 18, 24 months out. And you don't have interest accruing that usually ends up converting into stock. And investors are okay with that. It's the most common investment vehicle, I think, on AngelList, lots of different crowdfunding sites, and in the San Francisco Bay Area, and increasingly all around the country. My clients sell safes all over the East Coast, Texas, Southern California, Miami. So it's increasingly popular. And why? To me, the main reason why is because this does not allow one safe investor, let's say $100,000 investor in a $1 million round, from arbitrarily demanding their money back at the maturity date, one note investor asking for their money back at the maturity date and blowing up the operating plans of the company, or a financing round that's about to happen because they've lost confidence for whatever reason, or maybe they just need their money back. If you don't have the right to get the money back, you can't arbitrarily demand, right? That's it started out in the Bay Area because I think a lot of the people who were angels have 10 million plus in net worth, and they're actually, they think of these note and safe investments as either I'm going to get zero back, or I'm going to get my targeted return, 5x, 10x, 20x, whatever it is. And they're not concerned about that case where, or they're concerned, but they don't try to get their money back from the convertible note at maturity. And that's sort of proven out by the fact that in most cases, when you ask convertible note investors for an extension, they usually extend it because they have the same idea. They're supposed to have that idea in mind. And then you should always try to get the pre-money safe, like I mentioned, instead of the current Y Combinator safe online, which is post-money for the reasons I discussed. But when it comes to safes, some investors still don't get it. If you can raise under a convertible note, it's pretty much the same thing, again, except that with a maturity date or interest, and then you can tweak the terms to make it not so difficult by, for instance, making the notes automatically convert at the maturity date, or to make the interest not convert into shares but get repaid at the first equity round. One more note on the note and the safe investments is that investors will often ask, bigger investors in particular, modifications of the safe form with side letters, right? So what are the major rights they ask for? The first one is most favored nation, which basically limits the company's flexibility to offer better terms to investors who invest more money later, or even in the same round, because it automatically gives them, gives the prior investors all the same better rights that the new investor has. We generally recommend the founder rejects that, maybe compromises by giving up some of these other rights. But of course, if it makes sense, the amount invested is a lot, and you don't think you're going to give better return, you think the valuation cap is going to keep going up, and what does it matter, right? So, but we usually recommend trying to do without. Pro rata rights is probably the number one most asked for thing. It's very important for an angel investor to get the pro rata rights, because if the company is actually doing well, to avoid further dilution when subsequent equity rounds come in. It's a good idea in many cases to invest, good money after good money, right? So it's basically a right to purchase the same percentage of the next equity round equal to the percentage of the company that the note or safe converts into in that round. Okay, and this is generally perceived as dilutive to the founders because the lead investors who negotiate the valuation have not incorporated the additional dilution from note and safe investors investing their pro rata amount, right? So it is not something you want to give away willy-nilly because when it adds up and it can end up diluting you more than you expected and people are disappointed. So give it out sparingly, just like any other special right. But this is not so bad if it terminates at the closing of the next round of funding, which is market. If it keeps going through the next 5 rounds, that could be an issue because each one of the new round investors may not want to give the old investors those rights. Board or observer seats. So it's not typical to give note or safe investors a board seat unless it's a very large investment. Observer seats are fairly common, but if you have a board meeting or you're just going about your business and you have to give all the information you would give the board of directors to 5, 10 observers, it becomes a pretty big administrative burden. So again, give it out sparingly, only to the right or to a select group of investors, if any. And blocking another right. Some safe note and safe holders, especially with counsel not very familiar with these investments, will ask for a lot of blocking rights. Like we want a right to, you have to get our approval to sell the company, to raise money, to enter into a big contract with yourself or others. These types of things. You generally want to try. It's not market, so you want to try to avoid that. All right, now preferred stock. Preferred stock is the engine that built the Silicon Valley, whether it's Hewlett-Packard, Apple, Google, Zoom. They were all funded by venture capital firms who invested in Series A, B, C preferred stock. The old model from the 70s, 80s, probably through the 90s, raised Series A, Series B, Series C, go public. Things have changed. We talked about the pre-seed and the seed round. So usually the first equity round is the seed round, and they say the Series seed round is the new A round, given the numbers that are involved. And that's pretty much the case. So the most important term of the Series seed round is the valuation. It determines what percentage of the company investors get. That's what they're most concerned about because that's going to determine their projected return. And that's quantitatively what they look at what they want to look at a lot. So it's the venture math is if you're raising 2 on 8 for a 10 million post money, that means the investors are getting 20% of the company, right? Sounds pretty simple, but I see founders running into issues, not getting their term sheets reviewed or negotiating terms before the actual words are put in front of a lawyer who can help them out with things. You got to watch out for the price lowering techniques. What I mean by this is inclusion of the note and safe shares in the pre-money calculation, or including a 10% option plan in the pre-money instead of a 5% plan, for example. Because in so doing, they're basically just reducing the effective valuation, or saying that all pro rata rights exercised are all the dilution from that is taken by the founders. These are all price lowering techniques. Or another way to look at it is investor percentage increasing techniques, right? The investment amount is also important. It's usually, these days $1 to $10 million because that determines the percentage. The liquidation preference is usually 1x non-participating. So this is probably the most complicated term in preferred stock, but very important economically. So I'll just describe it. So in the 2 million on 8 deal that I just mentioned, if that company is then sold for $5 million, then the investors would get 1x of their 2 million investment, or 2 million, off the top of the 5, and then everybody else would get 3 million. But if the company was sold for 100 million, those investors would convert into 20% because that's more money. 20% of the 100 million, 20 million. And then the other players get, or the other participants get 80 million, right? If it's participating preferred, then the investors in the $100 million deal would get the 2 million off the top and 20% of the remaining 98. And as you can see, this is going to basically just reduce the common stock or the founder return. And then if you have subsequent series of preferred stock and they all have participating preferred, then that cuts into the early investors' returns too. That's why most investors and most deals, 99 point, probably 100% of seed rounds, but that are actually recorded with the data services, but even going up to Series B, C, usually not participate, or a very small percentage. The 1x can be increased to 2x or 3x. That's also not market and very, very uncommon. It's in fact more common to have the participating preferred, and that's again less than 1% usually. So it's just non-X, non-participating. Just stick with that. Board seats. Usually, you don't give up board seats in a series seed round. I would say it's usually an observer seat for the lead. Maybe if there's two major lead investors, two observer seats, which is maybe why you don't want to give every note and safe investor an observer seat, because then you have like 7 observers. If anything, it's going to be a minority seat on the board because it's such a small percentage of the company that's being sold usually that it only merits a minority position, meaning the founders retain control out of the seed round. That's market. Founders, in fact, tend to retain control out of the A round in today's market, if everything makes sense. And then there are blocking rights where the holders of majority of the preferred stock have to approve raising new money by issuing senior preferred, selling the company, dividends on the repurchase or the repurchase of stock, changing the size of the board, et cetera. You're generally not going to be doing these things without the investor's approval anyway, except in the case of the first two. So this is normal market, not a problem. You want to keep the list to that short list though, because it often expands to 10 or 15 with the wrong lawyers on the other side. And you might want to limit the blocking right on raising new money or sale of the company by making it over a certain value. So only if you're raising money under 40 million pre-money, do they have the right to block? Because it's such a great deal at 40, why would they have the right to block? Usually you don't give out any anti-dilution protection either to any common stockholder or the seed round investor. Usually there's anti-dilution protection starting with the A round, and that's only for the new cash preferred investors. There's something called major investor rights, which has a minimum dollar threshold, which is basically rights to get certain information about the company, like financials. Pro rata rights, that's the right again to buy a proportionate share of all new investments. You want to again give that out sparingly. You usually set the minimum dollar threshold at there's no typical, but 100, 250K, I would say, $500,000, million, depending upon the size of the round. And investors will also often ask for something called a vesting restart, or let's say you put 3-year, 1-year cliff vesting on your founder stock, and you've been working on the company for 3 years, and they'll just start off asking for a new 4-year vesting period with a 1-year cliff, and that's unfair. That's unfair because the standard vesting schedule is 3 years. I mean, they might argue that you were just fooling around for 3 years and you finally got your act together. You probably have counter arguments for that. And I find that most of the time when founders stick to their guns and say, look, I've earned this, and having me continue to vest is not going to further incentivize me. This is my baby. I'm all in. I work on this day and night, 24/7. They don't really have an answer except if you were to leave and we were to replace you as CEO, then it would make sense for you to have this many shares, and that's not such a great, because that's signaling that really they want the real reason I think most of the time investors want that kind of a schedule is in case they do have to replace you as the CEO. If you unfortunately have to leave, for some disability or something, or scandal, or God knows what, they just want to get some of your stock and have a bigger percentage of the company. So that's basically almost like negotiating the valuation. I put it at the bottom here to finish off strong, but maybe just as important as the pre-money for you. Just a quick note on other early stage financing methods, Reg CF, Reg A, Reg D. I'm not going to get into the details. Through crowdfunding websites like these three, which appear to be the leaders in the space, they're raising a lot of money for companies, but they usually tend to be consumer products, because a lot of they want their customers to get invested in the company. or it's easy to sell the stock to customers that love the product, let's put it that way. And maybe not so great for the average company. So keep that in mind. But they're getting more and more successful, more and more investors on the platforms, and don't disregard it. If you can get one, government grants are fantastic because they're non-dilutive. And always remember customer and supplier financing. Customers prepaying, suppliers deferring receipt of payment. And looks like we have about a half an hour left, so I'm just going to give you some quick information on the A rounds, because a lot of people think that if they can get to their A round after the seed round, then they've really made it and they have the right people helping them out, and they're probably going to make a lot of money. So again, what are the basic parameters? The strong founders that with the addition of an appropriate team to really go to market with that demonstrated product market fit. We described it before, meaning a market-ready product that clearly addresses the intended large addressable market. But 2 to 5 million in ARR, depending on the industry, usually raising 5 to 20 million. Q3 2020 median amount raised was 12 million. And the median valuations in Q4 2020 were 37.4. And this is all skewed up by mega rounds of 100 million plus. And is high from a historical perspective, and it went even higher in 2021. We just don't have the data yet, or I wasn't able to find it. I usually see valuations in the 30 to 60 million range for an A round. And the investors here are institutional VC funds, strategic investors, hedge funds, and prior round investors with the pro rata rights. Here is an old study. I was not able to find any new data, but CB Insights probably has it, which basically shows the revenue run rate of the companies raising an A round. We can see the round sizes were smaller back in this period, and as were the valuations and the exact revenue multiple based on the revenue run rate that gets to the valuation, et cetera. So that suggests that valuations make, and of course I can go through all of the terms of Series A preferred stock, but I thought at this point, why not open it up to Q&A to give us a half an hour? If you want me to continue, you can ask me for it.
Thanks, Joe, very much. This has been very, very informative. I'm getting a lot of questions and a lot of notes here. So we can start with some of the questions, if you don't mind. I'd like to know more about the Series A, but let's see where the questions are. Can you see the Q&A, or do you want me to read them?
Let's see whoever can get to one first. That's good.
Yeah, so on the bottom, if you hover over the Zoom, you should see Q&A, and it has 3 questions so far. Anyone with questions, please post them in the Q&A section so it's easier for us to moderate. And then there are also, Joe, there's some questions or comments also in the chat section. So one of them is long, so it's probably, if you could get to that one, better than me reading it completely.
Yeah, well, I see the one about, can the founder do all the paperwork to set up a Delaware corporation? So they have these, they have automated systems, that try to help people do this, like Stripe Atlas and Gust, all these things. And what I find is that a lot of people, they pay the money for this, and then they just, for whatever reason, because it's not user friendly, they don't trust it or whatever, they don't finish it. And then they send it to me, and then we finish it.
They still come back to you.
So, yeah, I don't know. I haven't tried it myself because, my team's doing this day and night, and it's sort of boring to me to look at, how they've automated. I could probably compete with them very effectively if I wanted to go into software development, but
Well, I'll tell you one thing that we heard the other day is that Gust is actually automating the valuation, and that was really a little bit disturbing. So, all right, next question.
Well, I mean, that, I guess it depends if it's investor friendly or if it's company friendly, right?
Yeah.
So this is made by David Rose, who's founder of the New York Angels. Then,
Yeah.
what do you think it's going to come up with? So it's probably, and because the valuations are so high, he thinks it should be automated to get people back down to earth. But I'll talk to
No,
him about that.
they were higher than we thought. I mean, not lower.
Oh yeah.
All
Okay,
right, next
good.
question.
I'm trying to license from a government agency. Technology is published in a technical journal. Is it still protected for me if I license it? So, I mean, I guess it depends to some extent to what extent it is published in a technical journal. But once something has been published, I think it's for more than 1 year, it cannot be patented. So make that more clear. If the real trade secrets are actually published in a technical journal, then you can't get patent protection. And the only thing that you can do to succeed in commercializing that vis-a-vis other people is to get out ahead of your competitors by the speed of that commercialization and market share, getting market share. But we can talk about that offline, and it's sort of a complicated question. Can you recommend any websites to read about all this? No, I mean, not really. I mean, unfortunately, what I would say is that most of the websites out there are very often very wrong, and you want to be very careful about that. I mean, there are some, but there's more danger in, I think, looking at the internet or the websites than not. More examples of supplier and customer financing options. Well, it sort of depends on the specific business, Patty, and you can actually type in what your business is, and that will cause me to think about, what the example marketplace is. What do you mean, like e-commerce websites? Is that what she means? Marketplaces?
I don't know. Yeah, I'm not sure. If you can explain more, Patty, that would be great. B2B.
B2B marketplace.
Okay. Yeah.
All right. So, well, I mean, I'd have to think about that, but the basic idea is if the customers are prepaying, then you're getting the money to create inventory, right? Or to build your company, to build more people on both sides of the platform. But I don't know if it makes sense in your model to make them prepay. Suppliers, I mean, what most people do, whether it's a Fortune 50 company or a startup, is they slow roll payment on all their debts or all their creditors, right? They pay in installments.
Yeah, but it's a great financing because it's better than investment if you can do that, but it's really hard to get.
Yeah, I mentioned Kickstarter on the sort of the crowdfunding. A lot of people have used that successfully. I don't know how successful it is anymore. Please talk a bit about exits, including
medtech. Non-equity crowdfunding, right? The Kickstarter.
Yeah, that's right. Yeah. Like people invest. They prepay for a product, $250 each or $25 each, and then there's a minimum that has to be raised so that you can go out and build all those products, and let's say 50 grand or 500 grand. Talk about exits, including medtech exits. I mean, it's such a broad question. Are you saying like, what are the valuations like? I mean, the valuations are everything from $1 million to multiple billions in medtech. What is the typical type of exit? It's usually getting acquired or going public. I just don't even know where you want to go with that, but you can follow up with that. When should I incorporate at the of Series C? Anytime before. Investors like to have a say in the incorporation details, right? So the short answer is you should incorporate, like I said, when you have more than one person working on your company, or if you have potential for significant liability in that company, because the investors definitely do not want to have a say in the incorporation details. They expect a certain type of incorporation, which is there's basically 20 law firms in the country that are good at doing that, including mine. And I've sort of outlined in this presentation the way that's supposed to work. And in other words, an equity agreement with vesting was sort of a standard form that all those 20 firms would use. Standard service agreement for everybody that's working on the company to protect the IP, all that other stuff that I talked about. They're going to be expecting that. So, you can defer that incorporation, but, and, usually we say you want it to be at least 2 months before the seed round closes or the price round closes, right? Because you don't want to issue everybody their stock the day before your equity is valued, because then if the pre-money is 10 million, then you've just given all the stockholders 10 million of stock and potentially ordinary income, and the IRS may come after them for it at some point. So especially if the company is acquired for stock and under certain circumstances. But and the second thing is that how are you going to sell a convertible note or a safe to an investor before that price to equity round if you don't have a company, right? Like that original diagram that I had, the investor wants to see that the founder has signed the right agreements, that the team has signed the service agreements, and who has the equity and all that stuff that's inside the corporation documents before they will invest in the note or the safe.
Yeah.
Okay, basically any wisdom you can share to help a founder gain contextual competence regarding exits. Contextual context, competence.
That may have
there's
to be
all
an offline.
Yeah, there's all kinds of information on M&A, if that's what you're referencing, online, and that information is actually pretty reliable. One board member is enough to start a corporation. In fact, we commonly recommend that where you have a one founder operation, or if you have one, because it's difficult to have a two founder board, because what if there's a disagreement and there's deadlock, and then three founders, unless they're all strong contributors, why would you want to give every single one of those people that much power over a company? For example, if there's two main founders and one subordinate, and you wouldn't want that subordinate or smaller participant to team up with the other one and fire you and take all your stock, right? So it's always simpler for you if there's only one director.
There's a question, a long one, and I think it's an important one. Let's see if Jeff Koenig, can you talk? If you can, I'll bring you live. That way you can ask it, or unless you don't want to do that, and then we'll have Joe just read it. There is, do you see the question from Jeff? Does it make sense in your role to advocate for companies in the chat section?
You mean the one that starts per NVCA?
No, above that, just go up. It says it starts with, it makes sense in your role. You see it?
I just am getting through it. Well, I'll just read it. It makes sense in your role to advocate for company best interest. That is when I represent the company. I thought it was mostly entrepreneurs online, so I'm trying to give them the way they should look at it. If I'm representing investors, then I go on the other side and I flip that around.
You can flip it, but there you go.
But investors are always investing dollars they almost always lose, and it's good to understand that perspective if you're a founder too. Notes shift even more risk to investors who are giving up cash now in exchange for a future anticipated company value after it makes more progress, which it may fail to achieve. But similarly, investors, if they have great terms, may get the extreme benefits from investing early, with a really low cap, with a big discount. What is wrong with the viewpoint that notes should be limited to short-term bridge financing and not be used as instruments that live for multiple years, that with so much debt waiting to convert, make it hard to find a lead for the next equity round? I don't think there's anything wrong with that viewpoint. We operated that way for years, but I think the problem is that it's difficult. The number one reason why it's difficult for investors and founders to come to agreement on what the valuation is. And the second benefit that I had mentioned was that it's a lot cheaper to do note and safe rounds. And there seems to be especially in today's very high valuation hot market, an infinite number of people who experience fear of missing out, FOMO, and so it's basically the market is driving the demand for notes and safes. Maybe perhaps after a little downturn in the tech economy, we'll move back towards the shorter term bridge financing. I think that's a good point.
Yeah. So there were also in the chats and right now in the Q&A, they're asking, does your law firm, do you have any packages that really incorporates all that in one package pricing? That's one of the chats earlier. Do you have something like
Yeah,
that?
I mean, our basic formation package is $1,500 for forming up the company to get it ready for raising money. I think that's the best deal in the Silicon Valley. Just
I
having
think they were
compared it
talking
against.
about all the different stuff like, maybe, a convertible note or a safe and, or a preferred, type. Do you have packages for that as well?
We have packages for that as well.
Okay.
Whatever comes up. Because a lot of people are afraid to just have expensive lawyers running on the clock, and
Yep.
this way they have some more certainty as to what it's going to be, right? So
Joe, some people are asking about your information. If you could flip maybe to the last page for now, so they could see it on the screen, or the first page, wherever that is.
yeah, I'll do that. I'll do
Yeah,
that.
so that way they
There's-
could see it while you're still answering questions.
Yeah, there you go.
All right, that's Joe's email address, so you can reach him there. And Joe, also you can give us a copy of the presentation, right? So that way everybody's asking for a copy of that as well.
Yep, no problem. Happy to.
All right.
I want to answer this question per MVCA from Helena
Yep.
Crowley.
Yep.
Cumulative dividend is quite uncommon, but what I am hearing from senior advisors with significant experience fundraising, this is common. Is this discrepancy due to the type of round? Yes, it's due to the type of round. So when you get to later stage rounds, you're investing at very high valuations. Like, for example, 74 billion for SpaceX M, Series M preferred stock, or 100 billion for Series N. And that becomes, there's less upside in that, right? Just until the IPO. So you'll see that having a coupon and participating preferred, these terms start building into the stock because it makes it more like debt. It makes it more like a senior loan, but it's still equity, and they can still convert and get whatever upside they can get. But usually you don't see cumulative dividends, participating preferred, those types of terms until Series C, and only in small percentages these days. But that's because the valuations keep going up in the private deals, and the IPO valuations keep going up too. So we'll see how that shakes out if there's ever any distress.
Okay, there's a question just above that regarding the CF. I don't know if you see that, allows a promissory note, convertible note, and equity. What do you think is the best path?
Yeah, so that what we're talking about here is the Regulation CF offering for a crowdfunding website. So only the crowdfunding registered crowdfunding portals like WeFund or Seed Invest Republic are allowed to conduct this kind of offering. And you can now raise up to 5 million if you have 2 years of audited financials, and then I think it's up to 1.07 million for whatever reason they came up with that number. If you have some lesser financials, I can't remember, it's unaudited 2 years or what, but and he's asking, Alan should it be promissory notes or equity? And to me, it depends on the stage of the company. If it's pre-seed, seed, and the amount raised is less than $2 million, even up to $5 million these days, I think safe is they have a crowd safe, for example, on Republic, just like the pre-money safe I was recommending, or a convertible note. Sometimes the platform will have a preference for one or the other because the people who invest on their platform tend to prefer one or the other. I think I described the convertible note and the safe and how they're very similar, and the difference is the lack of maturity date and interest in the safe. So if you can get away with those for the smaller amounts, then that makes sense. If you're raising over 2 million, then start considering equity if you're going to be happy with a particular valuation, and the crowdfunding portal thinks that you can raise money at that valuation.
Great point. I have a question for you, actually. When you talked about, I think you called it something else. So this is like the reverse vesting. Is this common enough, or you don't see it as often?
What do you mean?
When you restart the vesting, you called it restart vesting or vesting restart.
Oh yeah, I think that's common in VC-led rounds, where maybe the company's not that old, or let's say the investors gave you a really great valuation, and they want you to invest for another, like add another year or two to the schedule. I think, for example, on the East Coast, it's very common for investors to ask for an extended vesting schedule, but it's something you should definitely negotiate because it's 100% negotiable.
So this is taking away equity from the founders and then have them.
No, I mean, you keep the equity. It's just, if you had a 3-year, 1-year cliff schedule from the beginning, they just add on a year or 2 or 3.
Oh, I see. Okay. Well, it's here, many funds and also Tecos Angels and others, we call it reverse vesting. So take away some of the stock and then it gets vested over a period of time for the founders. So and it's been quite common lately, at least in my circles. All right, so let's see. There's some more questions here. Have you dealt with investors wanting collateral rights through IP or other? Yeah.
Well, if by collateral rights you mean having a security interest in the IP or the other assets of the company, I mean that typically comes in with a venture lender like Silicon Valley Bank. It's the classic venture lender, and they usually take a senior secured interest in all the company's assets except for the IP, upon which they ask for a negative pledge. And there are other types of debt investors like hedge funds, social impact, that invest in sort of startups, and they often ask for collateral. You just have to look at the situation and see if the collateral package is appropriate. If you have any follow-up questions on that, please type that in.
So that's interesting. Because you mentioned debt investors, and that makes a lot of sense. But I think she's asking more specifically about angels or VCs. I don't think I've seen it. Have you?
Yeah. So all the convertible notes and safes out there are almost they're always unsecured now.
Yeah.
Just not part of the deal.
Thomas,
I see the shameless plug for InstaRay AI. I'm gonna have to look at that.
Okay.
That level of confidence, good thing. Okay. Is there a conflict of interest issues we need to consider when customers want to invest in your company? For context, my company is B2B marketplace for pharmacies and wholesalers. Oh, that's the marketplace you were talking about.
Yeah.
So wholesalers, I don't know, Band-Aids, that kind of stuff sold at the pharmacy, or drugs.
Drugs,
legal.
Yeah.
Legal ones. Yeah. I mean, that deserves analysis, but I would be most concerned about a business conflict, like where they'll say they'll be happy to be a strategic investor. But I think on the whole, having your customers on the platform invest in your company is actually a great indication of validation of your platform, right?
Yeah. All right. Any other questions? You can
just answer that. Answer that in full. There's no legal conflict of interest. No, there's no problem there from a legal perspective.
Okay, that makes sense actually. Any other questions? You can type, or you can raise your hand, and then I can bring you for a live question. So if you want to ask it live, video or audio, you can do that as well. So just raise your hand, and I'll let you in. Let's see if there's anything in the chat here that we did not answer. Yeah, I guess there's a comment, safes that also don't show up on the P&L as well, which is a good point.
Yeah, another great point about safes is that you can start to get that QS, qualified small business stock 5-year holding period going from the minute that you invest in the safe, where that is not the case with a convertible note. Oh,
that's a good point. I didn't know that actually. Yeah. I did not know that. So
I mean, that's at least the position that everybody's trying to take. And the IRS has not said anything negative about it.
So they're forcing their own way of doing it.
Yeah, that's right.
All right. Any other questions? Okay, he just did. So there you go. Yeah. No, this is great. We'll, again, Joe, as you could tell, he's never done this before, and he doesn't know much about this stuff. So contact him just so maybe you give him some points, or maybe he'll really help you with your business. So the information is here on the screen. Please reach out to him, and don't forget to ask him about packages, because like he said, those are really important instead of having a spigot that you can never turn off. So all right. So thank you very much, Joe. It sounds like there are no more questions here. I appreciate your time here. This was absolutely fantastic. There's a lot of information here to pack, but you're going to send us the PowerPoint presentation. I'll send it to everyone here on the list.
You got it. My pleasure. And just, don't try it at home. Be sure you get the right help with my slides.
That's right. Yeah.
Thanks, everybody.
Thank you.